The Nifty is absolutely flat, down just about 9 odd points.
Now we're just down about 0.1% on the Nifty and the Sensex. Mid-caps yet again are holding up.
So 31,258 on the mid-cap index. The Nifty is virtually at the day's low.
Till about 1 p.m., the markets were trading in a very tight band of just about 50 points. Suddenly, you had that sell-off, and the Nifty went below 17,600, and now it's trying to find its feet. The Nifty went down to levels of 17,580. That was the low that the markets had hit even earlier this week, but it managed to respect that and finally close above 17,600.
Hello and welcome to Markets Today, the show where we track around 6 hours of the day's trading action in just 5 headlines. I'm Nigel D'Souza. Let's get straight to the headlines for the day. Another range-bound session for the Wall Street. The Nifty and the Sensex fall for the third straight session. Metals gain the most, while IT and media fall. ICICI Lombard slips 5% on missing the growth estimates and taking a cautious stance on the motor insurance, leading analysts to trim targets. But the company tells CNBC-TV18 it will gain from the new IRDAI expense norms and will outperform the industry growth by 200 basis points. Glenmark Pharma gains over 1% after it settles an antitrust drug matter for $48 million, while Piramal Pharma surges close to around 8% on successful completion of a US FDA inspection of its US Sellersville unit. Zomato surges post-clarification that most of Blinkit stores are now operational in Delhi's NCR region. AU Small Finance Bank falls despite RBI's green flag for license to deal in foreign exchange. Birlasoft also tanks on news that the company is in negotiations for dues recovery. While in the commodity market, metal stocks shine. The index gains close to 0.5%. Meanwhile, global rice supply to see its largest ever shortage in 20 years as Ukraine war and extreme weather conditions impact output. Well, here's what we have lined up on the show for you. In Market Opinion, we have Mark Matthews of Bank Julius Baer and Gautam Shah of Goldilocks Premium. Well, in Corporate Voices, we have Mr. Gopal Palachandra of ICICI Lombard. Well, let's get straight to the market action. Now, it was another volatile day of trade. Saw the Nifty as well as Sensex end in the red for the third straight session. The mid-caps and banks, they fell in line with the blue chips. The BSE companies erased a market capitalization of roughly around 74,000 crore rupees in today's session. Manglam Malu joins us to give us a wrap of all the market action. Manglam?
It was a largely range-bound session in today's trading day. In fact, the Nifty ended lower for the third straight session, and this decline was mainly in the second half of trade. Not too much, though. We had some support coming in from the likes of autos, metals, pharmaceuticals, and Reliance. However, IT and banks continued to underperform in today's trading session. By and large, the market is in a range. A narrower range would be 17,600 to 17,700. But if you want to broaden that out, is the 200-day moving average, which is 17,580, and 100-day moving average of 17,870, between which the Nifty has been meandering. But it was the mid-caps which saw some sort of gains in today's trading session as well, though the index ended marginally lower. The top gainers on the index today, we had the pharmaceutical names and the auto names, Divi's Labs, Bajaj Auto, as well as Eicher Motors. Whereas the top losers were from the IT pack. We had Infosys, HCL Tech, IndusInd Bank also dragged the index. Apart from that, the big gainers in the mid-cap end of things came in from Gland Pharma, Piramal Pharma, a couple of these rice exporters, KRBL and LT Foods, along with a few of these building producers as well, building material producers as well, Green Panel Industries and Lakshmi Organic Chemicals doing extremely well. Among the mid-cap losers today, we had Balkrishna Industries, ICICI Lombard and RBL Bank. ICICI Lombard, of course, on the back of weak results. Important to watch out for the way the market goes, because we do have a bunch of heavyweights reporting numbers in the later part of the week. Until then, we are expecting the markets to not move beyond this range that we've been talking about.
Well, thanks a lot for that, Mangalam. Let's move on then. Lackluster returns lead to a slowdown in demat account additions. The March data suggests that retail investors are now shifting focus to futures and options from the cash market. Surbhi decodes the numbers for us. Surbhi?
Well, March data from the exchanges and depositories is throwing up some pretty interesting investor behavior trends. First of all, the trend of new demat account openings is slowing down. Now, though the total number of demat accounts continues to rise at an absolute basis, the incremental new account addition is what is seeing that drop. March actually saw 19 lakh new demat accounts being opened as opposed to 21 new lakh accounts being opened in February. In fact, this trend, you can say the decline has started in January after having a decent end to the year. The number is also well below the monthly average of 29 lakh new demat account openings that we saw throughout FY22. So if you average out every month of FY22, then we were at 29 lakhs. That number for March is down to 19 lakhs. So that tells you about the pace of the decline. Now, lackluster markets are probably the key reason behind this drop in fresh demat account openings. And that could also be the factor behind the steady decline seen in NSE's total active client base, which has been falling for 9 consecutive months, according to Motilal Oswal, and it's come down to 326 lakh accounts in March. Now, mind you, even though the number of NSE active clients is almost down 9.5% in March of 23 versus last year, discount brokers aren't complaining. Their dominance actually has been growing steadily throughout the last 1 year, with the top 5, that is Zerodha, Upstocks, Angel One, Grow and 5 Paisa Capital, making up now for 60% of the market share. Let's come to another interesting trend, and this is retail investors, or should I maybe say retail traders, increasing their interest in the futures and options market. Let's look at the basic turnover trends to begin with. Now, despite the market remaining absolutely flat over the last 18 months, average turnover has been pretty healthy. In fact, it's up from 95 lakh crores in March of 22 all the way up to 236 lakhs crores. That's almost 150% jump in that 1 year period. Now, this is largely courtesy the rise in F&O volumes. Let's look at the average daily turnover in the F&O segment, which is up in March 148% over last year, and it's a 13% increase compared to February 23. It's not just seasoned traders, but retail has also decided that it doesn't want to miss out on the F&O opportunity. Motilal Oswal points out that retail segment average daily turnover has grown about 12.5% in March over February, the month-on-month growth if you're talking about Feb 23 and March 23. But the more stunning comparison is on a year-on-year basis. If you look at the average daily turnover in the F&O segment, retail turnover, then we're talking about a massive jump. From a level of 40 lakh crores in March 22, that number has moved up to 87 lakh crores in March 23. Contrast this with the cash market activity, and cash market retail volumes have actually dropped in the same period, the year period, by a little over 28%, and they've come in at about 237 lakh crores. So there we have it. It's quite clear that the retail investor is willing to experiment with newer ways of making money and is perhaps heading from the cash to the futures and options market.
Thanks a lot for that, Surbhi. Well, let's get some market opinion then. Mark Matthews of Bank Julius Baer and Company looks at India as a long-term bet as valuations are still not very expensive. Let's hear Mark.
Longer term, India is our structural bet in the emerging markets, and all the usual reasons that I won't bore you with in detail, but the demographics, the structural reforms, the move up the value-added ladder, all of those good things. And actually, having not really done anything for 18 months, the valuation in India isn't expensive either. It's come down to its average versus emerging markets.
Well, moving to the second headline now. ICICI Lombard plunged close to around 5% on missing growth estimates for the fourth quarter, leading analysts to trim their estimates and turning a little bit cautious. However, the management told us earlier today that they expect the insurance market to grow between 15 to around 17% in FY24. Surbhi Sutaria is standing by to fill us in with a detailed analysis. Surbhi?
Thanks so much for that. So ICICI Lombard will be in focus today. That's because the earnings were a mixed bag. The GDPI, which is the gross direct premium income, missed estimates, but the PAT beat estimates, and that was largely due to higher investment income. The GDPI was up 7% on a year-on-year basis. The net earned premium was up 12% on a year-on-year basis. The combined ratio also remained elevated at 104%, which was in line with the estimates. The company continues to guide a combined ratio of 102% by FY25. The claims ratio was also higher than estimates, and that was due to higher claims ratio in the motor third-party portfolio. The management continued to remain cautious in the motor business given the competitive intensity. Now that, combined with the regulatory requirement of bringing down the stake of promoter entity ICICI Bank, continues to be an overhang for the stock. Brokerages also have a cautious view on this. Jefferies has a buy rating, but they've cut their target price to 1560. They say for FY24, you have to watch out for the rise in cost of reinsurance and also how industry adapts to the expense of management rule. They trim their estimates by 3 to 5%. They further say that the stake sale and the CEO succession may limit the re-rating of the stock. JP Morgan has a neutral rating, but they've cut their target price to 1160. They say the motor portfolio is likely to remain competitive, and the comprehensive product portfolio, which is P&C, may see lower profitability due to increase in reinsurance rates. They don't have the visibility to price in a beat of the management guidance of 102% of combined ratio by FY25. Additionally, Morgan Stanley has an overweight with a target price of 1400. UBS has a buy rating with a target price of 1445, and Nuvama is the lowest amongst all. It has a hold rating with a target price of 1200.
Over the last 15 years, the market has compounded at 15%. And given the opportunity that one is seeing, even in terms of the road forward, particularly when you look at, let's say, FY24 or beyond, we believe the market should continue to grow in the range of 15 to 20%. And from an ICICI Lombard standpoint, we would obviously want to see a similar kind of maybe beating the market by maybe 1 or 2 basis points over the market growth rates from a revenue perspective. So there are multiple levers that we kind of work with. Clearly, in terms of increase in pricing is one of the levers that we kind of largely look at. For example, on the retail health, this February, we have kind of effected a price increase of about 19% on the renewal part of the health segment. So therefore, pricing is definitely one of the levers that we have. We equally look at actively focusing a lot on claim service efficiency, because that typically forms the bulk of the combined ratio breakdown if you were to look at. And third, and more importantly, we will continue to make our investments in various areas of expanded distribution, but early signs of success of those investments translating into incremental revenues is already something that we are seeing.
Well, moving to the third headline now. Glenmark Pharma gained close to 100% after the company settled an antitrust drug case for around $48 million. Piramal Pharma, though, that's been bucking the trend, and that's bouncing back. It was up close to around 8% today after successfully completing the US FDA inspection at its Sellersville unit. Ekta Batra joins us to run us through what excited both those two stocks. Ekta?
Thanks for that. Well, I'll start with Glenmark because that stock is in focus on the back of a bit of news. So Zetia is basically a drug which is used for the treatment of cholesterol. And what has taken place is that in a pending antitrust and consumer protection litigation in the US on Zetia generic, Glenmark was named as a defendant. So what has taken place is that the company has agreed to enter a settlement with a group, with a party which was litigating against Glenmark on Zetia generic. As per the settlement, the company is going to pay $48 billion to direct purchasers, which is basically the group which is a part of this litigation, based on the agreement entered. The trial, remember, for this case was scheduled to begin on April 19th in the US courts. Now, just to give you a bit of a background as well, there have been multiple lawsuits in the US in connection with generic Zetia all the way since 2010. Lawsuits allege that the company had entered into an anti-competitive agreement. So there was a pending lawsuit with regards to Zetia generic, which is now settled, and the company is going to be paying $48 million in terms of the settlement. It does come as a positive because there's an overhang which is out of the way, and this is a generally a normal course of business for most pharma companies. Remember, the amount which we've spoken of is not that large in terms of a sum, so hence maybe the street has brushed it off. Glenmark is anyway close to a 52-week high. Piramal Pharma is in focus because the US FDA has concluded the inspection of the company's Sellersville manufacturing facility. They've issued an establishment inspection report, which means that the inspection has concluded successfully. Now, this is important because this has been one of the USPs for Piramal Pharma, that they have an excellent track record when it comes to the US FDA. They, in fact, have closed all 4 US FDA inspections since November 2022 successfully, which includes the Digwal facility, Riverview, Lexington, and now Sellersville. So this is definitely a positive for Piramal Pharma. Remember, the stock is also corrected very significantly from that listing price of around 200 rupees odd last year, and maybe there is some amount of value buying that the street is recognizing with regards to their track record.
Indeed, that appears to be the case, Ekta. Thanks a lot for that. We'll time to slip into a short break, but you don't go anywhere. We'll be back in a jiffy, run you through the remainder of those headlines.
Helps beat sensitivity fast. Sensodyne Rapid Relief.
By selling stake in the 4 group companies, and the buyer is GQG Partners.
Tune in to NSE Closing Bell as we spot deals before they happen, decode their impact on stock prices, and help you stay ahead of the markets. CNBC-TV18. Follow the leader.
Welcome back. You're still with us here on Markets Today. Well, let's run you through the remainder of the headlines that we're tracking for you, which brings us to the 4th headline today. Zomato was up in today's trading session. The company has changed its delivery partners' payment structure after delivery partners waged some protests. The food delivery platform has also clarified that most of its stores are now operational. Manglam joins us to give us a quick analysis on that. Manglam.
Well, Zomato is doing well in today's trading session, mainly because the company has now officially recognized that it's made changes to its payout structure for delivery partners of Blinkit. Remember, the last couple of days, there were a bunch of delivery partners protesting that. I'll talk about more that in just a bit. But the thing is that, because of this, they had to shut down a few of their stores. The company is saying that now all those stores have resumed operations. In their overall scheme of things, this accounts for less than 1% of their revenue, which is why they didn't, have to explain it to the exchanges unless asked. So as a result of which, materiality is very low. Now on to what has changed as far as the payment structure is concerned and why there were protests. So the payment structure for the delivery partners for Blinkit earlier was 25 rupees per delivery flat, and now it's changed to variable 15 rupees plus a percentage basis the distance that the delivery partner travels. So, the delivery partners weren't happy with this because they thought they would get lesser, but ICICI Securities believes that this is a positive for Zomato for a couple of reasons. One, it increases the delivery radius of every dark store, and secondly, helps the company's Blinkit business go ahead and expand its network without any significant capital investment, using the new payout structure itself. So that's a positive for Blinkit. But over and above all these things as well, a lot of brokerages have been sounding positive incrementally on Zomato over the last few trading sessions. In fact, Motilal Oswal recently initiated coverage on the stock, citing good tailwinds for the food delivery industry itself, and as a result of which the stock doing well today.
All right, Manglam, thanks a lot for that. Well, Angel One tumbled close to around 3% despite reporting a rather good set of numbers in the 4th quarter. Mr. Dinesh Thakkar, the chairman and MD of the company, said that they are in investment mode, they will focus on market share and not on cost-to-income ratio. Let's hear him out.
We are not focusing more on improvising our cost to revenue ratio, because we want to focus more on market share. So this time it was better because there was one reversal of ESOP cost, which was not a big amount. But primarily what I wanted to say is that we are into kind of an investment mode where we would be focusing more on getting market share or getting more wallet share from a customer. Impact on our profit and loss would be around 40 crores because we have to raise more capital.
Well, AU Small Finance Bank, it was a little lower in today's trading session, but it had some good news. The RBI gave it its green signal for authorized dealer category 1 license for the bank to deal in foreign exchange. Well, Abhishek joins us to break that down for us. Abhishek?
Well, as you mentioned, AU Small Finance Bank has got the AD1 license, which is authorized dealer category 1 license. So this license allows the bank to deal in foreign exchanges. License will allow bank to serve the needs of their importers and exporters who are the customers of the bank, and also it will provide inward and outward remittance as well. The move also will put the bank almost in par with universal banks in terms of product offerings. Almost about 90% of the product offerings that universal bank does, AU Small Finance Bank bank can do. So the step is also closer towards getting a universal banking license, and analysts do say that this can add about 35 to 50 basis points to pre-tax ROA from the extra PSL sell down, that is priority sector lending sell down. The move is very good given the fact that last week we had RBI extending the term of the MD of AU Small Finance Bank by 3 years. This coupled with the AD1 license does indicate that RBI is comfortable with the recent growth trajectory seen in the bank. Remember that for Q4 business pro forma, we saw loan growth tapering down to about 26% level from 38% that they had in Q3. So good point for AU Small Finance Bank towards becoming a universal bank license possibly in the future. Back to you.
Well, in more stock-specific news, BEML Land Assets, the demerged non-core business of BEML, made a weak debut on the Lal Street today. The shares of BEML Land, well, it listed at around 290 rupees per share. The stock first hit a 5% upper circuit, but soon dropped closer around 10% and hit 5% lower circuit. Now remember, the positive is that this listing paves way for the partial divestment of the government stake in BEML. Remember, the government is looking to sell closer on 26% stake in the company. Well, Birlasoft slumped closer on 2%, but we learned from sources that the company is having advanced negotiations with Invacare for recovering dues. Vivek is picking up all those details. Well, Vivek, tell us more about this story.
In what could spell significant relief to IT company Birlasoft, we understand from our sources that the company is actually in advanced negotiations with Invacare for recovering some of the dues that Invacare owes to Birlasoft. What we understand is that, the company could, number one, recover some of the unpaid pre-bankruptcy dues from Invacare, and we also understand that there could be a one-time settlement amount too that Birlasoft could receive from Invacare. Now remember, despite Invacare actually going ahead and declaring bankruptcy, we understand that at this point of time, Birlasoft continues to provide some of the software services as it's a lights on as far as Invacare is concerned. Now, just for some context, remember, Invacare had signed a 10-year deal with Birlasoft, and the total value of the deal was close to almost $240 million. And when you're talking about the annual contribution, it contributed almost 3 to 4% of Birla's total revenue. So Invacare was an important client as far as Birlasoft was concerned. We reached out to the management of Birlasoft. What they told us was, at this point of time, the Invacare matter is still sub judice, and we have no further comments to offer on this particular development as of now.
Thanks, Vivek, for that. Well, moving to the fifth headline today then. Metal stocks, they were some of the top performers in otherwise volatile market. The metal index closed with 0.5% gains. The metal prices also trade firm on the back of a decline in the US dollar. Aluminium is trading near 6-week highs. Copper as well is near 1-month highs. Manisha Gupta joins us to round up all the metal action today. Manisha?
It's been a good day for the metal prices, where we have seen strength, one, because of the US dollar decline, and second, because the Chinese data continued to be on the stronger side. We were already soaking in the first quarter GDP numbers from China that came in firm. The retail sales and the factory activity also has seen improvement. And on top of that, now the China new car sales gained up by nearly 10% for the month of March on a year-on-year basis. And there has been the China automobile output also gaining by nearly 15%. So that means better demand of metals, and this is a quarter when you also see better construction demand coming in. That's keeping the prices in flavor. So palladium prices are trading at a 2-month highs. You have nickel prices also trading at a multi-week highs. Markets are looking at weaker inventories with LME. That has been a supportive factor as well. So aluminum prices trading at a 6-week highs. We've seen nearly 2.5% of gains in last 2 trading sessions come in for aluminum. Copper is trading at a 1-month highs with inventories at 2005 lows. And then nickel, as I already told you, 7-week highs coming in for that one as well. Zinc is trading at a 2-week highs with LME zinc inventories at lowest since 1989. So various supportive factors which are keeping the metal prices in the positive.
All right, Manisha, but global rice supply as well is set to see its largest ever shortage in 20 years. As per Fitch Solutions, the ongoing Russia-Ukraine war and extreme weather conditions will hurt production of rice, which are driving up prices. Well, Ukraine, remember, is one of the top rice producers in the world. Manisha, what are you tracking in this sector as well? Rice prices moving higher. The stocks are very excited today.
Well, rice clearly has been a story today, especially after the Fitch report that suggested that the global production is going to be the lowest in 20 years. And they also forecasted that the global shortage would be at the tune of 8.7 million tons. That kept the prices higher. And then the street was in any case looking at the previous financial year exports data for India, which shows that there has been a 16% of a jump up in sense of rice exports in value at the tune of $11 billion. The quantum, though, stands at 21 million tons, which is more or less as compared to previous year as well. But it is the value in which the numbers clearly have surged. The expectation, though, is that as we move ahead from here, the exports from India could be lower. If last year was 15 to 20 million tons, this year could be 5 to 10 million tons, is what the industry tells us. And the demand from China is yet to pick up. South African demand is on the weaker side as well. So while we have seen a blip, a reaction to the report and the last year export numbers, the street believes that the Indian crop is sufficient this time around and the international demand not so much. So we are looking at a range-bound trend going forward when it comes to rice as a commodity.
All right, thanks a lot for that, Manisha. Well, on that note, though, we'll have to wrap up on this edition of Markets Today. Thanks so much for watching.